Pay close attention to this breakout from previous highs. When markets recover from previous times and decisively break out, like gold did a few years ago, massive price movements are common. I believe that will be the case. Silver News Daily is airing right now. More content is available with a subscription. Almost no one knows what the $50 silver breakout implies, but it's here nonetheless. Most investors probably won't give it much thought, because it's simply another fleeting headline, spike, or rally. Imagine, though, if I said this wasn't even a peak. This might set off a dramatic shift of wealth that has never been witnessed in the history of precious metals. It's a technical confirmation that has been building for decades. Why? Because this pattern on the chart is not coincidental. It's the same structure that has been building since the 1980s, a cup and handle formation that caused gold to jump 25% in 2023, when it broke out above $2,000 for the first time. The silver version, however, is much larger and more profound, and some of the world's foremost macroeconomic thinkers believe that we are only in the early stages of a tremendous parabolic slide. What the general public still doesn't understand is this. Leave the bubble behind. Reversely, it is true. This asset's price motion represents a violent revaluation after decades of suppression, neglect, and a horrific undervaluation. A complete revaluation of silver's value in light of the current global situation of devalued currencies, spiraling government debt, and uncontrollable deficits. When you consider that mining equities are still trading below $20 per ounce, you can see the problem. This is not your average rally either. As the market tries to re-evaluate decades of denial, you might expect gains of 10x in certain names. This is no ordinary moment. Changes your life could be possible. So, what led us to this point? If this chart pattern is indicative of future events, then what are they? Alright, let's get begun. The catalyst is always worth its weight in gold, in my opinion. Looking back at the past reveals how far we've strayed from the original argument for silver, as many have brought up solar panels. Which is quite a bit, isn't it? There is zero correlation between it and the central argument for silver. It's fantastic. That's merely supplementary material to the theory, and it's undeniably flattering. But that won't be the source of genuine change. It will stem from the fact that gold is a store of value and an inflationary asset, both of which serve to propel its price higher during gold cycles. Additionally, I believe gold has sent a signal that a cycle has begun. Perhaps it began some time ago, but now I merely think that it has been confirmed, and that silver will be the next metal to face the same problem. At the same time, the mining firms should follow suit. So, one is operational and the other is volatile. Both entail comparable amounts of risk due to the asset's characteristics in relation to gold and the market size. What do you see when you step back 30, 40 or 50 years? I know a lot of people look at 6-month or 1-year charts of these assets and firms, but those are just the tip of the iceberg. I thought we hadn't seen anything yet. So far, what we've witnessed is really a blip. People are so worried that we've seen enough. This is a bubble, and it's fascinating. The most common question I heard during the Precious Metals Conference at Beaver Creek was, "Are things too frothy?" Excuse me? So yet, nothing has been observed. Look, we haven't seen anything yet, but my goal is to let folks know when it's too frothy. Wow, this is just fantastic. This is proof. There's no denying that in the short term, all of these items appear to be overbought. Would I be able to beat that overbought message? I don't make a living doing that. Things that are secularly changing are the ones that I invest in. And if you think that way, you wouldn't deal in such a back and forth. There is no way around this. That's too much thinking on my part. Also, I don't believe anyone else is. Now is the moment to invest in high-quality goods, start a business based on these trends, and fasten your seatbelt. The next 5 or 10 years are going to be fantastic, in my opinion. This is more than a bug. It's the last piece of evidence supporting a trend that has been developing for more than 4 decades. The cup and handle arrangement, a very dependable technical setup for silver, has now finished. The chart is now blatantly positive, with spot prices breaking past $45 and touching $46.71. On a daily chart, this isn't just background noise. Looking at the yearly and quarterly timeframes, we can see a pattern that began in the 1980s and is now indicating a gradual ascent toward $90 or maybe even $100. Before skyrocketing to new heights in 2023, gold followed this exact arrangement. Although many were skeptical of gold's breakthrough at the time, it ultimately served as the catalyst for a 25% rise in a single year. Then silver started acting similarly. However, this time, she was much more aggressive. With 20% more trading volume than typical, silver reaffirmed its breakout in September 2025, and the metal climbed about 15% that month alone, breaking beyond its intraday high of $49.50 from 2011. There is no retail FOMO here. Serious institutional capital is responding to confirmation from a technical standpoint. The cup and handle pattern is more than simply a tool for analyzing price history. That much is apparent. It foretells actions to come. When this structure finally emerges, suppressed assets' true value is realized, and enormous repricings ensue. If the breakout remains in place, we could reach $88 before 2028, and we could achieve $48 before the year ends, according to Investing Haven. Silver is still projected to reach $60 by 2026, according to even the most pessimistic projections, such as TD Securities. However, $50 is the true deciding factor. That isn't a purely arbitrary figure. Finally, there is a psychological hurdle. When it's broken, it lets in a deluge of information. Now that prices are so close, silver's setup isn't even potential, and it's moving. The relocation has started. Whether or not this is genuine is not the issue. Is your position ready for what's to come? Reason being, this shift has only just started, according to the data. Enormous break above previous peaks. Price fluctuations of this magnitude are common when markets decisively break out of previous epochs, as gold did a few years ago. In this particular instance, I believe that to be true. Furthermore, mining corporations are continuing to trade as though silver prices are substantially lower. The fact that these companies are still mining silver at prices below $20 per ounce means that any gain in silver prices, even by just $1, gives them a substantial advantage in generating free cash flow. As we witness the realization of this metal prices scenario, it will be especially advantageous for those who are prudent regarding the energy situation and can effectively hedge energy costs. Our official Silver News Daily Telegram has just gone up, so we'll be right back. A 10-ounce silver giveaway will be held to commence the proceedings. Exactly. Silver in the form of metal, not a voucher or digital credit. All things related to precious metals, including silver, market analysis, collecting recommendations, and more, will now take place in this telegraph. It's the heart of the community. The 10-ounce silver giveaway entry form is here. For more silver news, subscribe to Silver News Daily on YouTube. Go ahead and activate the alert bell. 10 ounces to be given away in 3 different videos. Participate in the Telegram group and introduce yourself. 10 ounces of silver will be sent to one lucky winner if we reach 500 active Telegram subscribers. Go to work early and keep moving. The $50 mark is not the end point. A fuse, that is. The The subsequent action will not be slow or methodical either once it catches fire. A parabola will form. This is the main mistake that a lot of investors make. $50 is seen as a barrier. Nothing can break a silver wall. However, from a technical standpoint, $50 marks the beginning of a considerably greater measured advance that aims to reach $90 or possibly $100. That is not sci-fi. Math is involved. We have now entered the acceleration phase, which is the culmination of decades of chart structure. Give this some thought. In 1980 and 2011, silver was close to $50 for the previous two occasions. This occurred amidst a backdrop of global political instability, currency devaluation, and spiraling inflation. And on both occasions, silver produced quick and rapid gains. It went from less than $6 to $50 in a matter of months in 1980. There was a meteoric rise in 2011 from $9 to $49 in a little over 3 years. Moreover, the macro view is now considerably more dramatic. On the other hand, this time, it's more than just a hypothetical explosion. It's the definitive proof of a technical foundation that has been there for decades. The words of Tavi Costa are not minced. He highlights the pattern's secular power by calling its breakthrough explosive. This isn't just an overshoot, folks. When a move is in its early phases, the real underlying dangers have not yet started to be priced in. The previous $50 ceiling is quickly becoming a new floor. As a result of the dollar's collapse, the debt to GDP ratio rising over 130%, and central banks shifting into tangible assets, this change in perspective is crucial. The moment $50 turns into support instead of resistance, all models, algorithms, and risk-adjusted portfolios will need to reevaluate their prices. The actual influxes don't start until then. Then volatility skyrockets. And then, as is customary during times of crisis, the silver market goes vertical. Playing the wrong game would result in you thinking $50 is the top. There will be more. This is the tipping point. There is, in my opinion, a way to look at the twin deficit problem and see how it impacts a typical business. As a business, you're losing money year after year. Plus, there are two ways to deal with financial bleeding. Raising capital requires taking on debt or diluting your shares. This will be funded by the US government's debt. What this means is that the US government, like any other business, relies on two main sources of funding. They have two options: either increase tax revenue or address our well-known expenditure problem. As a result, our revenue is falling short of our expenses. Therefore, there is a shortfall in government funding. As for the second, it happens when exports exceed imports. Additionally, I am aware that there has been much discourse regarding this budgetary matter. Yet the trade crisis, which is nearly as serious, is receiving far less attention. When looking at the building structure from the 1800s forward, it ranks among the worst we've encountered. Looking at that makes you realize that we have a problem with twin deficits. We also have record high levels of debt. The rate of interest accruing on such debt is unprecedented. To top it all off, the dollar is extremely expensive in comparison to other fiat currencies. In my opinion, the obvious trade is in physical assets, and I'm not going to budge from that position. It's still going on. This is evolving. The point that some are ignoring is whether or not the fact that the US government can't afford to have a strong dollar would lead to other fiat currencies appreciating against the US dollar. I think that will also be true in this situation. In light of the fact that the DXY index has fallen to its lowest point since the 1970s, I am firmly of the opinion that the recent significant move in the US dollar is being digested here. In my opinion, the most important thing to watch as we see this digestion is whether the dollar is just bouncing off of important support or if it is about to break down and fall in value compared to other fiat currencies. I lean toward the second opinion. In my opinion, that trend will have far-reaching consequences in the global economy. And when we observe that taking shape here, which I believe will occur soon, it will also drive something else, which is emerging markets in due time. Yields suffer when the dollar is weak, relative to other fiat currencies, and countries like the United States are compelled to engage in financial repression by reducing interest rates to address their fiscal concerns. Therefore, a decline in yields and a weakening dollar are necessary. In terms of Latin America's emerging markets, those are the typical ingredients for an appreciation. As a result, my attention is fixed squarely on the next trend, which is that a large portion of the flows here from these macro shifts will be directed into Latin America and other emerging economies. The leverage turns generational at this point. The reason being that mining stocks are getting ready to go vertical while silver is about to double in price. Why? For the simple reason that silver miners are the best possible call option. As the price of metal goes up, miners don't only benefit, they proliferate. They are currently trading as though silver has not yet broken out of its $20 range. All right, let's dissect this. Silver miners should expect an average all-in sustaining cost, AISC, of $15 to $18 per ounce in 2025. By any measure, that's a record-breaking gap, especially considering silver's current price of $46.71. Free cash flow throughout the industry is anticipated to increase by $100 million for every dollar that silver climbs from here. The astute investors are keeping an eye on this. The reason for the influx is this. As an example of a canary in a coal mine, consider the Global Ex-Silver Miners ETF, SIL. The year-to-date increase is 25%. Until you consider that the stock is still priced at only 12 times its forward earnings, it doesn't sound too good. Close to 18 times has been SIL's demand in the past. We are rapidly closing that gap. When it occurs, stock prices won't rise arbitrarily. They are going to reevaluate prices in a manner that resembles tech stock craze more than anything related to metals. Also, the establishments are taking action. A 10% increase was observed in SEL inflows during Q3. They aren't sitting on their hands, but rather jumping in before the retail crowd gets up. Since individuals who have researched the subject thoroughly are aware of the results of previous SIL bull markets. Parallel to SIL's doubling in 2010, miners' numbers tripled. Some juniors skyrocketed 10 to 20 times in the early 2000s. If the underlying asset has broken out, but the underlying equities haven't kept up, then this kind of upside can only occur. Not just that, but this is practical. With SL breaking $50 this year, Tavi Costa is predicting a 50% increase in mining prices. Peter Kraut takes it a notch further, predicting that certain miners may beat the metal by a ratio of 2 to 1. Here we have a return of 100%, with SIL up 50%. When mispricing meets leverage, this is the result. The question is when, not if. All they need is SIL to maintain their position. The re-rating could be severe if the market finds out how much money these corporations are making. Investing in a region that has been overlooked for a long time, has little flow of capital from developed markets, and is economically dependent on its abundant natural resources, presents a unique opportunity, in my view. I believe that growth will be driven, in the end, by the rising prices of commodities caused by the asset bull market that we are entering. Finding a depressed multiple, a really depressed multiple, historically speaking, PE ratios. Price? is the pinnacle of success for equities market investors. Okay, so a lot of people think that this company selling at those levels is because of its extremely low PE ratio, which is a value trap. Look at it from a macro perspective. A lot of companies are trading with PE ratios in the single digits. It seems to reason that the market is reflecting limited growth, which is why companies trade at single PE ratios, right? There will be zero expansion, and who knows, maybe they'll even close shop in the coming years. Because of this, they're doing so poorly. As an example, consider the company Redbox, which rents out DVDs and the like. After Netflix entered the market and everything, that company's stock price remained elevated at 4 times earnings for quite some time. Plus, everyone is predicting that this enterprise would fail financially. It seemed like this was going bankrupt, at least according to the market. It is being traded at a 3 or 4 year-old price. Accordingly, it was essentially stating, all right, this thing has around 3 or 4 years left to run as a business. In my opinion, these Brazilian banks do not have another 3 or 4 years in their current positions. So, I'm curious as to why they're trading at such low multiples. I also happen to hold the firm belief that major commodities tend to exhibit a wide variety of correlations with the markets in Brazil, Peru, Mexico, Argentina, and Bolivia, as commodity prices rise and money flows into the economy. Seeing it happen will lead to expansion, won't it? Therefore, you should expect to see both depressed multiples and significant growth. For those who invest in the stock market, that is paradise. People haven't caught on to this yet, in my opinion. As I mentioned a few minutes ago, I am still really enthusiastic about mining, which is why I felt the same way a few years ago. From a relative perspective, though, I still believe that the emerging markets are where the asymmetry is most pronounced now. The continued undervaluation of these mining equities only serves to heighten the absurdity of this arrangement. Silver prices are about to hit record highs, yet many producers are still trading as if it's 2015.